Hi, everyone. Welcome to Tax Tuesday. My name is Amanda Winalda, and this is
Elliot Thomas.
Elliot Thomas. We're just going to take a few minutes to get everyone online. For those of you who are joining us again, welcome. For those of you who have never joined us before, you are in for some tax fun. I know that sounds kind of like an oxymoron,
No, not at
but we're all nerds here, so we love it. We love tax. We're bringing knowledge to the masses. So why don't you go ahead and put up into chat? We want to know where everyone's joining us from. It's always fun to see. We're based out of Las Vegas,
We
Nevada.
are. Fabulous.
The fabulous
Las
Sin
Vegas.
City, but we keep it PG here at Anderson. Anderson also has offices in Draper, Utah, Tacoma, Washington, Cheyenne, Wyoming. Yeah, right?
For Anderson, US, yeah.
Yeah. Anderson Global, check us out. We're going global.
Yep.
We're taking over the world.
Yes.
Kind of like the T Swift of
Yeah.
tax and legal.
Yep.
All right, we got someone from Vegas. So
There you go.
if you're in Vegas and want to be a client, you can come meet us in person. That's always fun. We don't get to see everyone in person. What else we got in the chat? Hawaii, love it. Florida, always a lot of clients in Florida.
Yes. Yeah. A lot of good tax there.
Good tax?
Good taxes. No tax.
No state tax. A lot of influx of people going from I'm originally from California. We have a lot of clients in California. They're all like, peace out, California.
Right.
Going everywhere. All right. Let's get to this. So Tax Tuesday rules. This is a live Q&A. So please put your questions for our team. We've got a whole host of tax pros here with us, CPAs, attorneys, stuff like that. Put your questions into the Q&A. The chat is used more for if you're having any technical difficulties. Our events team back there can help you out. We have a set of 9 questions today. We'll go over those. But if you want to ask or submit questions, you can email them to taxtuesday@andersonadvisors.com. They're Elliot here. If you say something really nice about him, he might pick your question for next time. He reads through all the hundreds of questions that we get and picks the ones for every Tuesday. If you need a detailed response, you can become what's called a platinum client. So our platinum membership is a monthly membership that gives you access to our tax and attorney team to ask whatever question you like. Trust me, you will not have the most insane question we've ever heard. That is a fact. But this is a really fun educational way for us to reach out to the masses. We always like to say Anderson is an education company first. So we love doing this type of thing. I'm going to move to our next slide here. Opening questions. All right. So we've got 9 questions.
We do.
Do you want to take turns reading them? You can go first.
Okay.
I've been talking a lot already.
All right. Well, you're doing good at it. Is there any capital gains tax when my son inherits my property or stock? It's a popular question. We get that a lot.
The second question we're going to go over, it's hi, I'm selling my home in South Florida soon and would like to relocate to North Carolina. I would like to reinvest a portion of into a rental property and another smaller home when I move to North Carolina. What's the best way to pay the least amount of capital gains taxes after selling my Florida home?
Popular question too. How does a 1031 exchange work? What about a reverse 1031? And in fact, when we were getting ready for this, we probably had a good 20% of the questions. That's a lot, all about 1031. So we're going to try and give you some background information.
Oh yeah, very popular strategy to save on taxes, especially with the higher interest rates.
Yes.
All right. If I'm selling a property where not all the investors want to roll their money into a future investment through a 1031 exchange, is there a legal way to still do a 1031 for the investors that want to participate? I like how they clarified with a legal way.
Right.
We're only going to show you legal ways. So thank you.
Cross out a lot of ideas. We had a lot of other ideas, but none of them legal. So we'll look at that. I have recently opened my Wyoming LLC, set up a bank account, a business bank account for the LLC, and funded the LLC out of my personal account. I have since used the deposit of funds to make a limited partnership investment in a syndication, very popular investment. How do I best document these transactions for tax purposes? We're going to get some detailed information about how do we document, what's the best way to do for a tax purpose.
You might even phone a friend on that.
But yeah, we're going to probably do that.
We have a backup. If my LLC distributes dividends to the partners, do the partners pay tax from the money they receive from the LLC?
Good question. Should I take depreciation on a rental property if I don't have a tenant that year, or should I wait until finishing repair? Although it is habitable, I'm a licensed realtor, by the way.
And that's actually some good additional information that opens up some other possibilities for us.
Mhm.
Is it better to work as an independent contractor than to have an LLC in Florida?
Lots of things we know about
A lot
that.
of people in Florida, they got a
Yes,
lot of questions.
yeah, they were asking a lot. Would a new startup with no revenue for the first 2 years file taxes for those years, or only when the third year when the revenue was generated?
A lot of topics there. All right. This is our fearless leader, Toby Mathis. You most likely found us through this YouTube channel. He's kind of a YouTube star. He has one of those YouTube things in his office. It's like
Placard or
the plaque,
Yep.
the award for, I guess he's gone multi-platinum, as they say, or something. He gets those every year. So this is his channel. You can also join on YouTube. We've got somebody, one of our pros in the background, answering questions on YouTube. All of these Tax Tuesdays, although we're live now, the recorded version will be posted to this YouTube channel. So please like, subscribe, all that good stuff.
Absolutely.
Smash that subscribe button. All right.
We got
We
this
also
other guy.
one of our other partners, Clint Coons. He's based out of our Tacoma office. He also has a YouTube channel. It deals more on the asset protection side of things, but you get a little bit of both on both. We also have our upcoming tax and asset protection workshop. Anderson's really great because it's tax and legal under one roof.
Yes.
You may not speak legal or tax, and you don't have to, because we speak both. So you're not having to translate between multiple professionals. But we've got our tax and asset protection workshop coming up on June 8th. That's a virtual event. And then June 15th, which is also a virtual event. But if you want to come see us live in Dallas, we will be there June 27th through 29th. And that's really fun. You don't get to go.
No, I don't go to.
Elliot will be at the ones in Vegas. I'll be there. I'll be flying in from Hawaii, actually.
Very nice.
That's how much of a tax nerd I am. I'm leaving my family in Hawaii a day early to go hang out and
Dedication.
talk about tax in Dallas.
There you go.
But we'll have a bunch of attorneys. Michael Bowman will be there, who's our other partner, Clint Coons, Toby Mathis, as well as a bunch of vendors and different affiliates and guest speakers. So it's really a fun time. Really a fun time.
Great chance to get ideas from one another.
Totally a great networking event. So again, subscribe on our Anderson YouTube. You can see the link there for the replays. Let's get this party started, Elliot. Is there any capital gains tax when my son inherits my property or stock?
As always, it depends, but generally
That's a
speaking,
lawyer
right?
answer.
It is, and
That's what you're gonna get here,
right.
guys.
A lot of that, except for the illegal we talked about in that other question. But your capital gains, you can inherit. You get stepped up basis when you inherit. So if we had your traditional stock, let's say it was AT&T or something like that, you can leave it to your child. They get it at the fair market value on the date when you passed or 6 months later, but nonetheless, it's basically this fair market value at the time that you passed. So they could sell right away and not pay any tax on it. Now, there's also some exclusions if, just a lifetime gift tax exclusion of approximately 13 million. I think it's about 13.6.
Yep.
Goes up a little bit each year.
Yep.
And you can combine that in a spousal situation. Basically, that's 27 million. So we're really not talking a lot of tax for inheriting until we get a lot of money.
Yeah, so that means if your son is inheriting and your estate is over, if you're single and your estate's over 13.6 million, your estate would pay the 40% estate tax only on the amount above that. Most people are not falling well below that.
Not there yet.
So there's no capital gains tax to transfer it to your son if you're gifting it or if you're passing it to him when you pass away.
But as we were talking about earlier, there's also the concept of what we call stepped up basis, and that's just on your son's going to get it at the fair market value again. So that kind of ties in with this as well. So we want to cover that. But there is another contingency that we run into now and then where we've had clients who put something maybe that's appreciated value into a S corporation perhaps or a C corp.
And then we're talking two different issues when it comes to the capital asset and what your basis in the property is.
So let's walk through just a quick example. If you had a C corp, you wanted to leave it to somebody, they're going to get the stepped up basis in the share value of that C corp or S corp. It's going to be based even by that appreciated value. So in other words, if we have a rental in our S or C corp, we look at the fair market value when they inherit. that's going to give you the value of the shares. So that's how they determine the value of shares. So in that sense, you get the stepped up. And if they were to sell right away the whole corporation, well, then that'd be good. But what if they want to keep it as a rental down the future? Maybe they have it's an S corp. There's a rental, and we're just going to leave our kids the shares of the S corp. Well, then we have a different problem with depreciation.
Mhm.
Any ideas what might happen there? Well, we're not going to, the house itself, remember, it doesn't change, gets owned by the corporation. So if we've already been taking depreciation, we have something called adjusted basis, which is just the original fair market value, less depreciation over the years.
Mhm.
And that's the assets. I mean, excuse me, that's the corporation's asset. So S or C corp. Now we go and someone inherits it. Well, they still own the S corporation. That's correct, but there's no stepped up basis to the S corp in the asset itself. So they're going to keep that old straight line depreciation, or worse yet, if it's already fully depreciated, there's no depreciation going forward. Even though we just inherited and we got the stepped up basis of the value of stock, we don't have any benefit. And boy, do we look to depreciation for a lot of our
Yeah.
deductions
A lot.
and our strategies. So some things to consider if we have, don't panic if you happen to have an entity that has property in it, but you may want to talk to us. Now, we're not talking about flipping property. That's something different. That's where we do use your corporations. But if you do run into this, talk to one of our business advisors, get in to the Anderson team here, and maybe we can help you out.
Yeah. Okay. Next one. Oh, all right. Hi, I'm selling my home in South Florida soon and would like to relocate to North Carolina. I would like to invest a portion into a rental property and another smaller home when I move to North Carolina. What is the best way to pay the least amount of capital gains taxes after selling my Florida home? So, when we say home, we're going to assume from this question that you're talking about your primary residence, which immediately should bring to mind the 121 exclusion.
Right. And our 121 exclusion is just saying that if we've lived there and owned it for 2 of the last 5 years, you can exclude up to a quarter million single,
Mhm.
500,000 married
Very
family.
fairly jointly.
So that right there, we got huge tax savings.
Yeah. So if your property is below that or you sell below that, then you've already excluded all of the gain from the sale. You're not going to pay any tax. The actual rule is 2 of the last 5 years. Those years do not need to be consecutive. So you could have moved out of the property, lived in it for a year, moved out, moved back in for another year, as long as it's within that 5-year time frame. There are some slight modifications for if you are in the military and you're forced to move for active service. There are some exceptions where you don't have to quite meet the 2 out of the 5-year rule. But for the most part, that's not going to apply to other people. So if you're selling the home for less than 250 if you're single and 500,000 if you're married filing jointly, you don't have to worry about any capital gains. Now, let's assume that we're selling for more than that. So you've used your 121 exclusion to exclude some of the capital gain, but then you still have some on top of that. What can we do?
Yeah. So now, we talk about maybe, putting into other investments, as you mentioned here, as another rental property. Now, I want to step back just historically in this area of the tax code, because it used to be not so terribly long ago that for people my age, that when you sold your primary residency, if you spent all the cash on a new one, then you wouldn't pay tax. Well, that's gone. That was replaced by the 121 that Amanda just described. So maybe people still kind of cling to that and think, well, if I spend the funds into a new investment, I don't have to pay tax. That's not a case anymore. So now with Amanda's criteria here, we've sold it. We've gone above our 121 exclusion. So we have extra cash, and maybe we do get a rental. Now, immediately just buying the rental in and of itself may not help us, but we might have some other tools that we can use. We were talking about, Amanda had a great idea before the show about harvesting capital gains losses. Can you explain a little bit
Yeah,
about that?
so because it's a capital asset and you're looking to offset your capital gains, any other capital losses or even ordinary loss you can generate on your tax return for that year is going to help reduce that tax liability. So if you have loser stocks, you can do loss harvesting. A lot of brokerage firms you can just click a button and they'll automatically do that for you. So it's built in, or you can do it yourself if you're in stock savvy,
Yes.
I guess you could say. If you own other businesses that are maybe operating at a loss or you can sell at a loss, it kind of depends what other things you have going on. If we don't have any of those other options and we're just looking at this secondary property, this rental property, you can actually use it in such a way or rent it in such a way to generate some of these losses.
That's correct. And two primary methods of that would be one, short-term rental, and that typically just means that the average stay of someone staying there is less than 7 days throughout the year. And if you materially participate, you're the one running the show on that short-term rental. You manage it yourself, pretty much is the idea. Then maybe we can do some depreciation tricks on there, accelerated depreciation with cost segregation creates big losses. Those losses are just as Amanda was talking about, they're ordinary. They'll go against any other income on your return, especially your capital gains. Or we could go long-term rental, but we have some more steps there if that's going to help us out.
Yes, you do have to qualify as what's known as a real estate professional. And so that means that you're spending 750 hours in your real estate trade or business. So if you only have this one rental property, it's going to be pretty hard to meet that rep standard. If you're spending 750 hours on that one property, it's probably not worth it even to keep it around. But if you've got other rental properties already and you can elect to aggregate them all together, you spend 750 total, then you could potentially qualify for reps. The second part of that qualification is you need to spend more than 50% of your personal services on your real estate. So if you've got a full-time job, you're most likely not going to be able to do that. You're spending 40 hours a week working. You're not going to spend 41 hours a week on your real estate. But if you work part-time, or if you have a spouse that works out within the home who doesn't get paid with money like the IRS would recognize, then they can qualify as a real estate professional and you can meet this standard, which does the same thing as a short-term rental strategy. It takes all of the losses generated by your rental properties, turns them from passive losses into ordinary losses, and then you can use those to offset any type of tax liability, even the capital gains from the sale of your personal residence.
And there you have it. And just, a lot there just to unpack it real quick, pack it, I should say. Again, we're selling it. We're going to get that 121 exclusion, assuming this is our primary residency. We could sell some capital gains at a loss, and that would help offset our capital gains from that. We could maybe turn that new rental into a short-term rental where it's a little bit easier to take advantage of a cost segregation and bonus depreciation, or the real estate professional on a long-term rental that Amanda just described. So those are some options. Hopefully that helps you out.
And the great part about the short-term rental strategy is that you don't have to continue to operate this property as a short-term rental. I did a midterm rental with our last personal residence, and it was terrible. Interacting with people who are literally only contacting you to complain is not something I want to do in my free time. So you can actually do the short-term rental strategy for this year, take advantage of all the tax benefits, and then next year just be like, you know what, I'm just going to run it as a long-term rental.
I think that was the property I'd mentioned. Hey, isn't there, I went to a party there and you mentioned that it was probably not a good place to party and maybe it was at your house and I didn't know it was.
Yeah, we came back to a broken pool table at one point.
That was
Okay,
okay.
how does a 1031 exchange work? And what about a reverse 1031?
Good questions. Again, we had a whole lot of 1031 going on this time around. So basically your 1031, the idea is that you've got an asset that was used in business, okay? This means a rental, commercial or short-term rental, single family home, what have you. It's not being flipped, it's not inventory, it's just a working asset, okay? And the idea is that you want to sell it and not incur the gain, or at least defer the gain. And by doing that, you what we say sell, that's the relinquished property, the property we gave up, and then you're going to buy some new. We call that the replacement, and that's your 1031. Now, there's a lot more to it. We'll get into that. The idea is that you do have certain very stringent time frames.
Very stringent.
Yes. 45 days is the one we normally hear about, 45/80. 45 says if I'm giving up a property, if I sell it, I have 45 days to tell somebody what I'm going to pick up to replace them. And have to have that. And it's a stern 45 days and then 180 days to get it all buttoned up. Now, who is that person that we tell? We got somebody that has to help us out here.
That's right. You can't just do a 1031 exchange on your own. I've actually had clients saying, "Oh, I'm doing this as a 1031 exchange." You need a qualified intermediary or a QI. And I ask them, "Who's your qualified intermediary?" And they just have this confused look on their face. I'm like, "You are not doing a 1031
No.
exchange. You are just selling your property. You need a qualified intermediary." You can just go out onto the intranet, the interwebs, and find one. They're considered a fiduciary, right? They must
Uh,
be.
they're getting there. There's been some problems in the past, but they're getting up to that standard.
So definitely look at the Google reviews, but the qualified intermediary is going to pretty much call the shots. The funds from the sale will never hit your personal bank account. They'll go to the qualified intermediary who will hold it for those 45, 180 days, and then they'll execute the purchase for the new property. So the funds never actually hit your bank account.
So we talked about your traditional 1031. I give up, I relinquish a property, have 45 days to list what I'm going to pick up for replacement. What about the reverse?
The reverse is what it said. It's reverse.
It's just the reverse. This time I'm actually selling first. And then I'm selling the property first in the reverse, 1031. And then I'm picking up. So I have 45 days to get it out the door and tell which properties, excuse me, I have 45 days to buy the property and list which property I'm going to give up and have to have it all done within 180 days.
And the deadlines are very strict. Elliot was just telling me you did
Did a continuing education,
education.
fantastic professional in the 1031 business who is a QI. And she was given some really good examples of that 45 or 180 days. And she often would run into a situation where maybe the client lives in, let's say, West Coast, lives in LA, the property happens to be in Miami. And if they get down to that 45 days, they have to have that list in there or the 180 days. It has to be done by midnight of that time zone of where the property is located. And they do not mess around with that. It's very strict.
Yeah, so if you're West Coast or even
Yeah.
on Hawaii
Don't-
time, you
don't-
better get on East Coast time for that one.
Yes, exactly right.
All right. If I'm selling a property where not all the investors want to roll their money into a future investment through a 1031 exchange, is there a legal way to still do a 1031 for the investors that want to participate?
Excellent question. We get this a lot.
We do.
We're making another assumption here that probably we're talking about a partnership. And when we have a partnership, it's the partnership that actually owns the property. So if Amanda and I have a partnership and we have a rental in there, it's not like she can do a 1031, go off her way, and I don't want to, because it's the partnership that owns it. Neither of us own it.
Mhm.
And that's where we run into the situation proposed here. And this happens quite a bit. We get asked this a lot. And there are some things that might be able to be done to fix this and facilitate a 1031 down the line, but they aren't immediate fixes. In other words, what we can maybe do is we change it to where it's a tenants in common, and now we own it as tenants in common, but basically it would probably be outside of the partnership at that point. And then we can go our own ways. She can 1031 her part, I can go spin my part, or vice versa, what have you. Or we have something you often hear about, a drop and swap, where basically we take the property down, jettison maybe one of the partners that doesn't want to be in there, and pay them off, and then do the 1031 to the partnership who's staying around or something like that. There's some things that can be done like that, but none of these things
Yeah.
can be done, if, as we call it, in anticipation of the 1031. The IRS doesn't want us doing this right before 1031. There isn't a whole lot of
Mhm.
guidance out there for how long we have to wait either. It's just you have to wait a reasonable time and just show the IRS, well, that wasn't our intention for making this transactional change. The 1031 came out, it was an afterthought, that kind of thing. It's what they're looking at.
Yeah, what the IRS will do is it's not a statute, it's not going to be found in the IRS code. It's a legal doctrine that says if you do steps A, B, and C, and B is a superfluous step that didn't really need to happen when the result was to just get from A to C, then they will truncate it and treat it as if you just did A and C. So that's what Elliot's talking about in terms of doing like a drop and swap or pulling a property out of a partnership to take somebody off. If they look at it and say, well, what you were really trying to do was to get to here, and you were just doing these other steps to get the tax benefits solely for the purpose of getting the tax benefits, then they're not going to give you the tax benefits. You have to have some other business reason to pull it out of the partnership and get rid of that other partner.
Exactly right. Collapsible transaction.
Yeah. I think the thing that confuses people is that, and we have clients come to us all the time that say, I own this property, I own that property. Well, how it's actually titled makes a big difference. If you own it through a partnership, yes, in your mind, you still own that property, but you don't actually, you own the partnership. The partnership owns the property. So you could 1031 out of your partnership interests, but you would need a third party who would want to come in and replace you as the partner in that partnership. If it's with just a couple of partners, that's unlikely to happen. That happens on larger levels like Delaware Statutory Trust or bigger conglomerates. But if it's just a few partners in a residential real estate, it's unlikely you're going to find a third party who wants to 1031 into your partnership that you put together.
Excellent. There you have it.
Yeah, we're kind of flying through here. All right. And give me one second. Well, there we go. I have these nails and it's hard to like push the touch screen. Okay. I've recently opened my Wyoming LLC, set up a business bank account for the LLC, funded the LLC out of my personal account. Those are all the right steps. I have since used the deposited funds to make a limited partnership investment in a syndication. How do I best document these transactions for tax purposes?
Document. Well, I'm going to tell you that anytime to tax, all of our tax knowledge, everything we tell you is all going to be based on one thing, and that's the bookkeeping.
Mhm.
And I think we are going to phone a friend. Is that
We
right?
are. Troy.
Troy, you available out there?
Troy,
Hello.
Troy is the head of our bookkeeping department. I actually asked him exactly how, if you were sitting at the computer putting this into QuickBooks or whatever accounting software, how would you do it? He told me, but I'm going to let him tell you because I don't know if I could really repeat it.
All right. So when you put money into your account from your personal account into your business bank account, that's going to be a capital contribution. So that's going to be an equity account. How your tax is going to determine what equity account you will use. And then when you hang on, I'm reading the question. I've since forgotten every.
Yeah. So when you then make an investment into a syndication, how are you
Yes.
categorizing that transaction?
Yep. So that is going to be an investment in X syndication or X company, and that's going to show as an asset on your balance sheet. And when you get a K1 from that syndication at the end of the year, you can adjust to whatever the value of your investment is at that time.
So on the balance sheet, it'll start out as the value of what you put in. So if you
Of
put in
what you contributed.
$100,000, it'll be $100,000. And then when you get your K1, it's going to tell you whatever the new, hopefully increased value is, and you make that adjustment in your books.
Correct. Right. Or if there was running at a loss, you'll make that adjustment based upon the gain or the loss of the company.
Right. If all of that sounded confusing to you, then we highly suggest you go and get professional bookkeeping. Anderson has professional bookkeeping. Troy, did you want to talk about a little bit of like the new bookkeeping services we have?
Uh, I will gladly put a link in the chat to our bookkeeping website that lists out all of our different bookkeeping services. And we have things for people that are just getting started out. We have things for people that don't want to do their books anymore. And we thank you for that because without that, I don't have a job. So please sign up for bookkeeping services. And we also have things for people who are doing the books themselves and want to make sure everything's done correctly. So we have different services for all sorts of different people. And I'll put that link in chat now.
And we like Troy, so please help
Yeah,
us keep him around.
exactly.
Yes. Yes. Very important.
Good guy.
I like bookkeeping because, well, I mean, I don't like bookkeeping. That's why I like other people to do the bookkeeping. But I will say that there is some merit to doing your own books, at least in the beginning, because you understand what's going on at that level. Anyone who's ever had any sort of theft or something happen within their self-run companies, it's always the bookkeeper.
Yep.
It's always the bookkeeper. So as you need to understand what's going on. So that's why it's really great to do your own books for a while. But at the same time, that's not your skill set. If you were a bookkeeper, then you would do that as maybe it is your job. But if you're doing something else or you're moving and shaking and getting deals and that's your skill set, then lean on professionals to do that kind of thing.
Absolutely. It does take some time, but I think that Amanda nailed it, that it's really important. It helps you really learn about your business, having a little bit of experience, but then it is time consuming. You want to tap on Troy and company to try and maybe help you out with that, take that time off your schedule.
Right? Outsource that.
Yes.
All right. Should I take depreciation on a rental property if I don't have a tenant that year, or should I wait until I finish repairing, although the property is habitable?
Hmm.
I'm a licensed realtor, by the way.
Great question.
Let's start off with what is depreciation?
Yeah. Okay, perfect. At the very beginning, you originally purchased a property. Okay. And whatever, and there was an amount that was the cost of the land and what we call the improvement, the building itself. The building can be what we call depreciated. You take a little bit of the expense as a deduction each year. We don't get to deduct the whole thing right away, generally speaking. And land is not depreciable, so we're not going to be able to deduct that until the year we sell it. But it sounds like maybe we're doing some repair work here on this and adding, we call those improvements perhaps. And if they're improvements, well, that's going to go on to the value of the house. So in other words, let's say we bought a $500,000 house. 100,000 is the land value. That's not going to change. But we have that building that's 400,000, and maybe we did another 100,000 of improvements on it. So now our total value is 600, 500 for the house and land, 100 for the improvements, and the depreciable part is the 500,000. The house, which was 400,000, we added the improvements of 100, so we're at $500,000 there. We depreciate that traditionally over straight line. We divide by 27.5 years if it's a long-term rental, typically single family. Takes a long time.
That's a long time.
It's a long time.
It's even longer for commercial, 39 years.
Exactly. So it could be a long time. Short-term rental, that would be a commercial use, or if you had a the traditional commercial building, all 39 years. Well, there's some things that we can do to speed it up, cost segregation and things like that, and bonus depreciation. That certainly is going to help us speed up how fast we do. We don't add to the depreciation amount. We just going to speed it up. And so that's one of the things. But when do we actually start incurring expenses and income if there's any rent going on? There is a time frame that we reach where we kind of flip the switch and start doing that, and that's one we call available for rent. And there's really not, it's not a set term of what that means, but basically it's you've held it out for rent. You probably go and put an ad out there in the paper, and it needs to be really rentable. You can't just put the ad in the paper and then just not allow anybody to rent it because you're not done with your repairs or something like that. But at least it has to be available for rent. And that starts the clock of when we start taking deductions, such as depreciation, things like that, recognizing income, other expenses, and things like that. So in our question here, should I take the depreciation on a rental property if I don't have a tenant that year? Well, first of all, you don't have an option. I guess you do have an option. You have an option not to put the depreciation on your return, but the IRS is going to treat it as if you did. So if you later on sell, they're going to treat it as if you did take that depreciation, and you will not have had the benefit of that deduction all those years that you had it. So to answer it in that flavor, from that light, you don't have an option. You have to take it. As long as it's available for rent, you're going to take your depreciation.
Yeah. So, but just having the property habitable doesn't mean that it's necessarily available for rent. So if you wanted to start taking the depreciation deduction, then the bare minimum you need to do is maybe list it on Zillow, Craigslist. And then that would start it as being available for rent, and then you can start taking depreciation. How does the fact that this person's a licensed realtor play into this?
Well, we kind of talked about this a little bit in some of the previous questions. There's a lot of angles we could go with that. If the hours that you're putting in running this thing and managing it perhaps might help you go towards that real estate professional status. You're talking about the 750 hours, over 50% of your work week or your personal services week. And if you own your own licensed realtor business, say maybe it's an S corporation you get paid for, and you own over 5%, your hours just doing that outside of this rental, but just doing your basic job will go towards your 750 hours. If it's a short-term rental, it actually doesn't matter that we're licensed or not. I mean, that in and of itself, it just might help us get hours, but you don't have to be licensed to get to these states of material participation in case of a short-term rental, or real estate professional in case of long-term.
Yeah, so I guess we're looking, and when we're looking at timing, and this is it's June. We just started June. So how likely is it that it'll take the whole rest of the year to make repairs? I mean, I think of repairs as smaller things, not a capital improvement, which tends to take longer. So if you're looking to start taking depreciation and take advantage of some bonus depreciation with your real estate professional status, you don't have to hold the property out for rent until the very end of the year. It just has to be before before the end of the year. So, most likely you're going to finish these repairs and then you're going to be able to start renting the property out and making some income and then taking the depreciation to write it off. As long as that happens before the end of the year, you're good.
And that's a great point
Mhm.
before the end of the year, because that is a strategy that a lot of people take. Maybe get the property towards the end of the year, really quick, get it out there for short-term rental, put some time into it so they can get that tax
Mhm.
benefit. And that is true. And now you just got to remember that you probably want to continue it as a short-term rental into the next year a little bit. Toby, we had Scott Estel on here not too
Mhm.
long ago, did a lot of work with Toby, and he and Toby talked about in their episode about that if you have the short-term rental and we're going into the next year, you probably want to continue as a short-term rental, maybe into the next year, just to show the IRS that your whole intent wasn't just to take immediate depreciation and then turn it into long-term rental. But Amanda pointed this out earlier in one of the questions that doesn't mean you have to be the one managing year two. It can still be a short-term rental, but you can get someone else to do it for you. But you got the heavy write-off the first year because you were managing in that first year towards the end of the year.
Yeah. So the short answer is if the property is held out for rent, you should take depreciation because that's going to be imputed onto you regardless by the IRS. If you're looking to do something more creative like bonus depreciation, cost segregation, then you need those losses generated for this year, then you want to at least hold it out for rent before the end of the year.
Good points. Oh, and this guy again. There's a reminder about the shows that we have coming up here.
Our live tax and asset protection events. We're doing 2 virtual events in June 8th and June 15th. You could register on our website. And then you'll get an invitation to a Zoom link. It functions very similar to this. It's in a different studio across the hall, but it'll have a Q&A. We'll have attorneys and tax professionals to answer all your questions. It's been described as drinking from a fire hose.
Yes.
All of your tax and asset protection needs. But if you've been sort of looking through our YouTube channels and picking up on videos, this is where you're going to get everything all in one place. There's also some special offers there that are kind of the best out there. And then our live event in Dallas, if you want to come see us, please do.
Great times.
Cowboy hat not required. All right. Is it better to work as an independent contractor than to have an LLC in Florida? So when I first read this question, it's a little bit of a misnomer because you can be an independent contractor and have an LLC. Those two things are not opposites. When you're talking about from the tax side, you're usually looking at it being paid as an independent contractor versus being an employee. So let's first start there. What are the pros and cons of being paid as an independent contractor versus an employee? And do you even have a choice when getting paid?
Yeah, that's a good point. Sometimes you don't have a choice, but let's just say you did. Being paid an independent contractor, in and of itself, you kind of get to set your own schedule a lot of times and things like that. Whereas an employee, you have traditional benefits and you're kind of told what to do. So that's kind of just on the very surface of it. And of course, there's other differences. Independent contractor, whatever they receive, will be ordinary income, and it's going to be subject to employment tax on 100% of it. So
15.3%.
not a small amount.
Yep. When you're a W-2 salaried employee, you do still pay employment taxes, but you're only paying half.
Yeah,
And then your company's paying the other half.
exactly right. Employee side of it. So a little sharing of the load there on that. I think from a tax perspective, that's probably one of the biggest differences between the two at that surface level. I would say just because we talked about the one roof, if you're doing it as an individual, independent contractor in your own name, now comes in the evil lawsuit. You're really exposed at 100% personal liability if you're not doing it with an LLC. So we're always going to tell you, don't even think about a business without having an LLC, much less do anything. So certainly, just as Amanda pointed out at the beginning of this question, you want the LLC, regardless of what you're going to do. Here, if you're an independent contractor, don't ever do it in your own name.
Yeah, on the legal side, the question is not independent contractor versus LLC. It's LLC versus operating as like a sole proprietor. You never want to really do that. They're treated fairly similar from a tax side, but for liability purposes, you want that limited liability protection of the LLC. You can also, for greater tax advantages, you can have an LLC and elect to have it taxed as an S corporation, as a C corporation. So depending on what other kinds of income you've got going on, there could be a tax benefit to either one of those.
Absolutely. We got things like in an S corporation, the 280A Augusta rule meetings, that can be a significant tax play. You're going to have some self-employments. We just talked about at the beginning in an S corporation. Uh, you got 100% of the income coming through your S corporation. It's a flow through entity. So if you make $100, that's all going to hit your personal 1040 return. There, you only have to pay yourself a little bit of it, what's called a reasonable wage, a W-2. You become an employee of your S corp, but maybe you only have to pay $50 of that 100 as an employee. And that's going to be subject to every tax the IRS can throw at us, income tax, employment taxes. But that other $50 only going to get hit with income tax. You're already well above and ahead from a tax standpoint than if you were just that independent contractor where Amanda was pointing out all of it's subject to that 15.3. You've already saved just by making an S election. But we got the 280A. What's going on with 280A?
280A is often called the Augusta rule. It's the ability to rent out your personal residence for up to 14 days and completely tax-free. So you receive the rental income and you don't even report it on your tax return at all. So you can combine this with your own business by renting your personal residence to your S corporation. And you can hold a meeting, you can do a training session. You want to get quotes from local hotels or workspaces that are a conference room for a whole day, audio, visual, all the different amenities that you have at your home. And then any reasonable rate, which is actually any rate you can get, you can charge your company, and that's a deduction from the company as a meeting expense. And then it's income to you, completely tax free, as long as you do it 14 days or less. I had a client in Brooklyn.
Oh, nice.
And obviously, Brooklyn is a very expensive town. Vegas, we get this as well. But he got a quote for $3,000 from a local hotel, and he was able to charge his own company to have a meeting right there in his tiny little Brooklyn apartment, $3,000 times 14 days out of the year. So that's a really big deduction, and it's a way to shift income that would normally hit your S corporation and shift it into your pocket without any tax whatsoever.
And we also have what's called the accountable plan, which, as I always say, is just fancy IRS language for reimbursement. And one of the big things under there is if you have an administrative office. So we talked about the meetings. That's what Amanda was describing. I always like to say, as an example, let's say we have 1,000 square foot home or apartment. We got a back bedroom that's 100 square feet that we're going to use as an office. Well, maybe we do the 280A up front in the kitchen or family room or basement. It's a big 1,000 square feet.
It's got a basement.
Right. And that's where all the people will congregate for your meeting. But we're in that back bedroom, the 100 square feet. That's where we're going to have our office. And we would just take, typically, this is just kind of an estimate, 100 square feet for the office divided by 1,000 square feet for the whole place. That's 10%. So now 10% of all your costs could be rent, mortgage interest, property taxes, the whole gamut.
Utilities, internet. If you've got clients coming over to your administrative office in your house, you can deduct landscaping, cleaning, all these kind of normal business, these become normal business expenses. And the difference between doing that in, let's say, an LLC taxes an S corp, or just an LLC that would hit your Schedule C, is that there's a limit to that administrative office or home office on the Schedule C.
Yeah, it can be limited by the easy amount that everybody always takes. I think it's $3 per square feet up to 500 square feet or something like that, but it's 1,500 as I recall. Nonetheless, it's very poor compared to usually the average.
The actual expenses.
Exactly. And remember, this is basically the tax, allowing the tax code to pay 10% of your costs. And that's huge. And there's actually things we can do to, I don't want to say manipulate, that makes it sound bad, but improve that percentage. We can take out the square footage in our place for unusable areas like restrooms, hallways, and stairwells. And let's say, again, in our mammoth 1,000 square foot, we have 200 square feet of that. Now we're dividing a 100 square foot office by 800 square feet, and that's going to be about 12.5%. So we can etch it up there a little bit more, and it just gets better and better. You couple that with the 280A, you're well on your way to tax. And we didn't even talk about, that's all the S corp, but if we have a C corp, we have another thing called a medical reimbursement. what's going on there?
Yeah, so any medical expenses, out-of-pocket medical expenses, you can essentially are treated the same way as expenses out of an accountable plan. You pay for them personally, you turn in an expense report to your company, and your company can reimburse you for those. And that's when we talk about out-of-pocket medical, it's anything that I like the shorthand version is anything you can get a doctor's note for. So prescriptions, life-saving surgery, things, orthodontia, things like that. It's not going to necessarily cover elective procedures or things. People always ask vitamins and supplements. That's a different plan, but in the C Corp, you can do that medical reimbursement plan. And that's really a great option for people who have high medical expenses, but not high enough that you can take that deduction on your Schedule A because of that 10% floor.
Yeah, and just like we did earlier, let's just kind of revamp and go or reset here. Independent contractor, certainly it's best that you have an LLC. We absolutely got to have the LLC for asset protection. But we have $100 come through and it's subject to all the taxes the IRS can give us, income taxes, perhaps state taxes, employment taxes and all that. Or we have an S or C corporation where you can have some tax savings perhaps on your employment tax. You got the 280A, you got administrative office, maybe the medical reimbursement. So it's kind of a no-brainer. You just have so many tax goodies on the corporation. Now we don't want to beat you up on the cost to set up, and maybe you have to, there's other formalities doing a return or something like that. So we usually recommend as a rule of thumb, maybe you're making 30,000 before we do that, just to make it worthwhile. Toby always likes to see 7 times his return on things. Not a bad, rule of thumb, and he's good at getting those. But here, there's just some things to think about, but more than likely, yes, you're going to want to be in a corporation LLC.
Yep. LLC, and then make 30,000 a year.
Good to
Make
go.
that S election. All right.
Sure.
Would a new startup with no revenue for the first 2 years file taxes for those years, or only in the 3rd year when the revenue is generated?
So I'm operating my business for 2 years, and maybe I'm going to start making money for the 3rd year. Am I going to do I have a duty to file returns?
You don't if you don't have income.
Could be. Now, what if I'm an S corporation or a C corporation? Well, then I do. But exactly as Amanda's pointed out, if it's a partnership, maybe I don't. And in fact, there are cases where we've had with a C corporation, well, maybe we don't have to file. There, we just say we didn't start the business till later on, and that's exactly right. So Amanda's absolutely correct. Many times you don't if you haven't made any income, but maybe I do want to capture those things. On an S corporation, it's a little bit different there because they do want us to file every year for there. So it does depend, as always, on how we're taxed in our business. We have this new startup. But you could potentially put it off if it's a partnership. Usually we don't say until you start a business. You may not be able to capture those expenses though. So that's another aspect to it. And it just depends how much we have here going on. If there wasn't a lot of loss, some clients, they'll kind of forgo that.
And that's kind of the big one because this question usually comes up because there's typically a cost to prepare a tax return. So in your first couple years, if you haven't made any money, it's not really fun to spend more money to file that tax return. So clients are coming in and asking, hey, can I get away with not filing this tax return, with not having more money go out the door before I have some money coming in? And once we go through the analysis, most clients are actually filing the return because if you don't capture those expenses, then you lose them. And so those expenses can go if you've got a Schedule C sole proprietorship, but in an LLC, those losses generated by legal fees, by paying for a registered agent, by paying to set up the entity with the Secretary of State, for any type of subscriptions or any expenses that you could take in that first year, that's going to generate a loss, and that loss can be used to offset other income on your tax return. Let's talk a little bit about the rules behind startup costs, because this one's talking about not filing a return for 2 years. So if we're looking at startup costs, typically you're looking at the 12, maybe 18 months prior to starting the business. Are we then going to be able to capture those startup costs on that 3rd year tax return? Because now we're looking at expenses that we spent 3-4 years ago.
Right. Well, the code itself doesn't have a time limit. We could go back to expenses from 1776 if we wanted to.
Oh, in gold bullion.
Right, there you go. Exactly. We were back on the gold standard. But the problem here is that you got to have a much, much stronger connection to those expenses to your business. And clearly, that gets ridiculous after a certain point. 2 years, we've certainly done it, but our rule of thumb really is about 18 months. That doesn't mean we can't go back because the code allows for it, but you're really going to have to show that connection that those expenses were really towards starting up that business. Excellent question. We
Yeah.
run into it a lot.
We do. And taking those losses now, even if you don't have, what happens if you don't have any income to offset them? How do those carry forward? And what situations do those carry forward?
So we could have a net operating loss, and again, often it depends how we're taxed, but it's still going to be an NOL, net operating loss either way. But a C corporation, it just keeps building, and then once you have income, it will help wipe out a lot of that third year income that we have here. There are some, particular rules that maybe you can only offset up to 80% or something like that. That is true. But usually that third year, if you've had a lot of losses the first year, the third year doesn't create so much that we're, out of bounds to be able to wipe out quite a bit of it. If it's on your personal return and it's just an ordinary NOL, then it will still wipe out. Again, same rules and limitations, but usually you can wipe out quite a bit of it.
Yeah. There's no downside really to filing the return.
I would, something we ran into, I've ran into this a couple times. It's been a while since we have hit this problem, but for a while, probably about 5 to 7 years ago, we would have clients who had a lot of R&D. They went out and spent a lot research and development, thinking that, well, I'm not going to set my entity up right now because, I listened to Toby's podcast or whatever it was, and I heard that, I can capture the startup costs. R&D is different, research and development. We can't do that. You've got to have a business already. You need to have that LLC as proof that you're running a business in order to start using that R&D. That's a little bit different. We cannot use R&D in startup costs, those costs we incur prior to setting up the business. So I just throw that out there because I've seen a couple of clients and they put a lot of money into that and they got stung on it, not knowing that small little caveat.
All right, we're going to hit you with our YouTube channel again. This is recorded, this is live now, but you can go onto Toby's tax and planning and asset protection YouTube website, subscribe, and every 2 weeks, right?
Yep.
If you can't make it to us live, you can get a notification that the recording will be up. We've got about 8 more minutes. Should we check out the Q&A?
Yeah.
All right.
It looks like we're at 99 questions already being answered by the whole team out there, 13 left open.
Oh, just went to 100.
There we go.
You guys are putting them to work. We love it. We love it. Okay, let's start at the top. Okay, would the structure for anonymity charging order protection be the property is held in a land or residence trust, and 2, a Wyoming entity is set up for property management that is also a qualified opportunity fund?
There we're talking probably about, obviously a qualified opportunity zone property. Got a property out there going on. You're going to set up the fund itself, which has to be, as I recall, a partnership or a corporation. And we're going to put money in there, and then it goes out and invests into another entity that actually has the property. I suppose you very well might use a land trust, though I guess I haven't seen one used, but I don't know that you couldn't.
I don't see that you couldn't. How you hold title to the actual property itself, as long as the beneficiary of that trust is the qualified opportunity zone entity. I'll be honest, qualified opportunity zones were very popular in 2020. It's like all tax rules or most tax rules. As time goes on, the benefit goes down. So we don't see a lot of people setting up opportunity zones right now because just the benefit, you can't meet the 10-year holding period to get the maximum tax benefit from it. So we don't see a lot of that very much anymore.
Yeah, but certainly it would not be a residence trust. We use that for something different. I'd even be a little shy of the land trust simply because qualified opportunity zone is a little bit different than our traditional structuring, and maybe they do require direct ownership. I haven't heard that you can't use it, but I'd be a little leery of that and may want to, have that researched a little bit more.
Yeah, for sure. Okay, we're going to jump down to, oh, wow, that question just got a lot longer than it looked at first. Okay, so this is a little bit like our Florida submitted question. We're potentially moving out of state for husband's job, and we're not sure if we're wanting to rent or sell our lake house. This person is a real estate professional and the husband is a W-2. We have about $150K of equity. and the rent would likely be 25 to 30%. I'm just going to read ahead and try to summarize. Okay, trying to get to the actual question. Okay, we're talking about cost seg. So if we put the residence into service in 2025, so looking at next year, and cost seg rapidly to depreciate, but then sell in 2026, what happens tax wise? So we're looking at a property that we've turned into a rental. We've taken bonus depreciation on, so we've taken more than straight line. So more than the tiny bit of 27.5 years. But then you turn around and sell it. To me, this rings of depreciation recapture.
Yeah, what is going on there? Depreciation recapture is just like it sounds. You take depreciation, they gave you a deduction, now the government takes it away. They make you pay taxes at ordinary rates on that, um, with a little asterisk on that, up to 25%. Here, we talked about a cost segregation. So let's say we didn't do the cost seg and we were just doing regular straight line depreciation. Under the code, it's a little bit in depth, but yet that's called 1250 property. You just have a house. And when you do depreciation recapture, it's going to be limited to 25%. But the problem is you want that heavy cost seg deduction, and then you break the house out into what's called 1245 property. That's your 5-year property, your 10, anything under 20, 15 year. And then you have the rest of the structure that's still 27.5 or 39, and that's still 1250. When you do depreciation recapture on that 1245, there isn't a limit there. There's not a 25% limit. So it's going to be at your ordinary tax bracket rates. So you've done yourself a favor early on by doing your cost seg, getting all your write-offs and everything that you mentioned there. But then you're going to turn around and sell relatively quickly. And maybe we don't get a whole lot. A lot's still going to get taxed. And so really you don't know until you pencil it all out. That would kind of take a little bit more of a consult there.
Yeah.
So
Maybe in this situation, you're thinking 1031.
right, exactly. That's all the questions we had today. You see how popular that is, because now we could just defer the tax. Perhaps that's an excellent idea. Absolutely. There you go.
Yes, on it.
A small one.
Again, for the third time, we will be reminding you of our tax and asset protection event. Who puts these slides together, Elliot? We got 2 virtual events on June 8th and 15th. I believe Toby and Clint will be teaching those. And then our live event in Dallas. This is super fun. Please join us. They are really fun.
Everyone gets there. The clients love it.
Mhm.
The staff gets to go out there. We don't, because
I get to go. I'm special.
But yeah,
And it's nice to put faces to names, because we're based in Vegas, so we deal with clients all over the country, sometimes all over the world, a lot of phone calls. And so getting to meet people in person is super fun.
it is.
All right, questions. Not for today, for next time.
Sweet.
Email us taxtuesday@andersonadvisors.com or visit us at Anderson Advisors. How many times do you get a question that at this point, because this is episode
220.
220. So there are 220 other episodes, probably better than this out there on the YouTube channel. How many new and novel questions do you get at this point?
They still come up. They do, and I try and pull those if I can. It's like, hey, that's really unique. We had one I remember, and Toby, Toby doesn't really need to look at the questions beforehand. He just kind of rolls into it.
He has a photocopy of the IRS tax code in his brain.
This is all really true. Give you a little behind the scenes here. And I picked one I thought this was really interesting. The client was investing in whiskey or something like that. And they would, then they'd sell the whiskey. It's obviously been around for several years or however long whiskey sits.
A long time. I feel like that's 100 age barrel, a long time.
They found it from some ship or something like that, so it's got a story behind it.
Wait, they found the whiskey on a shipwreck?
I just throwing that out there, but some story behind it that the value goes up. And Toby's like, "Oh yeah, I've invested in that. That's da da da." And so the point to Amanda's question is, I look for questions like that. It's like, wow, that's really unique. And I thought that would be a really neat one. And Toby's like, "Oh yeah, I've done that."
Tried to stump him, couldn't do it.
No, you can't do it.
The point is, please send us your questions, because there's always some little nuance to it that can maybe bring something up. But if you are just looking for general tax info, we've got 219 other episodes besides this one to go back on the YouTube channel.
More coming.
You can search by keyword, things like that, and I'll bring it up.
And we try and hit the broad questions. Like we had, like I said, over, I don't know how many questions about 1031. So I try and throw some of those in there too. So we get a little bit for everybody.
Yeah.
And I guess that's it. Until next time, have a great 2 weeks.
We'll see you then.
Thank you.
Have a great day. Bye-bye.